Yesterday, the Reserve Bank of Australia elected to hold their equivalent of the overnight cash rate at 4.25%. This is one of the highest rates for a developed economic country in the world. The reasons behind this decision were threefold. Firstly, there's a view that the grassroots economic recovery in the US is going to continue. Secondly, that Australian employment data will continue to hold up. And thirdly, that any turbulence coming out of Europe will only be mild. However, that view was not held by a number of the world markets overnight. There's a growing pessimism that bondholders will not elect into the debt restructuring for Greece. And as a result, stock markets around the world took a tumble. In the US, the Dow was off nearly 200 points. And in Europe, it was a similar story with most markets falling. On currency markets, again, we saw a flight to so-called safe currencies, the yen being a primary beneficiary, being up 1.5% against the Kiwi. The Kiwi itself fell against most of its major trading partners with the exception of the Australian and ended up at around 81.2 US cents. In February, Sheep and Beef New Zealand released its mid-season report. And in that report, it was predicting a stellar year for New Zealand farmers. Looking at its all-class sheep and beef farm model, it's expecting net revenue to increase by 8.9%, leading to an increase in profit of around 14%. The primary driver behind it is a 10% increase in revenue derived from lamb sales. And this is primarily due to the fact that the number of lambs this year is significantly higher than last year. It was also expecting a 2.3% increase in revenue relating to wool. And again, this is related to increases in stock numbers as well as better clip. The only area where things are relatively static is in the beef cattle area, where revenue is expected to stay relatively flat, primarily because of the erosion of the high New Zealand dollar. On the cost side, Sheep and Beef New Zealand are expecting around a 5% increase in costs. However, this masks the fact that interest costs, they say, will be lower, driven primarily because of the retirement of debt relative to last year. One caveat, however, these figures are driven predominantly off US exchange rates, and this is on an expected 79-cent rate. As farmers will be aware, the US-New Zealand exchange rate has topped out at over 83 cents this year. So what the final result will depend on is volatility in those currency markets.